Hey all, I just wanted to show you a video, kind of show you the concept of the income taxes and the self-employment taxes and the payroll taxes, which are interchangeable. So don't worry so much about the numbers. We can mess with the numbers if you want to use actual numbers. I'm just going to pretend you made $50,000 as a W-2 employee and how that impacts it. If you were in 2024, you were a W-2 employee, made $50,000. You most likely got the standard deduction. Unless you itemize it could be more. Your taxable income is $35,400. Your income taxes is $4,000, and that's based off of this chart over here. So I was trying to tell you before where the first $11,600 is taxed at 10%. The next $23,800 is taxed at 12%. So not even though you're in the 12% tax bracket, the entire amount isn't taxed at 12%. It's just each chunk of money, so to speak, or each bracket. So that's why even though you're in both the 10% and 12% tax bracket, the effective tax rate is 11.34%, which is like the average tax rate compared to your taxable income. And then on your W-2, you also get your payroll taxes taken out, which is 7.65%, which is half of 15.3 since your employer pays the other half. So you pay total taxes a little under $8,000. Now, if you went to become self-employed or had your own business and you also made $50,000, it'd be a little bit different because you would have to pay self-employment taxes of 15.3% on the full amount, which is $7,000, double what you had to pay as a W-2 employee. However, the IRS is like, you can take half of that as a deduction up here. And so there's a difference between the gross income of $50,000 to this $46,000. And then this is $15,000 because I'm using 2025 numbers for this column. It's, pretty close. And then you also get this qualified business income deduction, which is new under the Tax Cuts and Jobs Act. This happened in 2017. Give you a little break for being a business owner, some incentives. And so your income tax based off of $25,174 is down here, where the first $11,925 is taxed at 10%, $1,193. The next $13,249 is taxed at 12%, which is $1,590. And the effective rate is only 11% because it's a blend between these two tax brackets. That's lower than what you paid as a W-2 employee, but you also pay a lot more in self-employment taxes. But the net effect of those two is you pay an extra $2,000 because now you are a business if you made the same amount of money as if you were a W-2 employee. Of course, within here, I didn't factor in any like expenses, business expenses and things like that, but this is just more so the concept between the income tax, which is right here, and the self-employment tax, okay? And then when you are a business owner, you can also have an option to go from a business owner that gets reported the income on your personal tax return to an S corporation, which is a business tax return. And so I think these numbers are the same. Yep, 9847. 9847 of what your taxes would be for if you were a business owner and reporting all of the income and you get hit with the 15.3%. So what people do is when they switch to an S corporation, they determine what a reasonable salary would be based off of how much money you made as well as the work you did. And what really you should say, like if I paid somebody, how much would I have to pay somebody to generate the same amount of income? If I had to pay somebody, I could probably pay them $20,000 and they could generate this $50,000 for me that we did. And if that's the case, we'll make $20,000 your salary and then the remaining is just going to be business income. So just the 20,000 is going to get subject to self-employment tax or payroll taxes, which is 15.3% because you are both the employer and the employee. You're the employer of the S Corp and you are the employee in this scenario. So you have to pay the 15.3%. And then you don't have to pay self-employment tax on the remaining 30,000. So the gross income is almost the same. In this scenario, you get a little deduction for the one half of self-employment. But in this scenario, instead of it being called self-employment tax, it's called payroll taxes, and that gets just taken off on your W-2. Standard deduction is the same. You both get the qualified business income deduction, and it is based off of the business income. So this is also based off of $30,000. And so the qualified business income is pretty similar. And so your taxable income is a little bit higher on the S corporation, but you also paid a lot less in the in the self-employment tax or payroll taxes, how we want to look at it. Same thing with these income taxes. The first 11,925 is taxed at 10%. The next 17,000 is taxed at 12%. So it's a blended rate of 11, just a little over 11%. When you add them all together, you would pay more in taxes if you were a LLC, report on your personal income, and if you convert it to an S corporation, even with this wage, you save just under $4,000 in taxes. And so that's the concept of why you want to switch from an LLC to an S corporation when you run the numbers. We always have to run the numbers, see what makes sense. And to follow up with your situation, we didn't issue you a salary for the S corporation just yet because we don't know how much income you're going to make. Let's just say you don't spend any more money and you keep the $50,000 of income, then it makes sense for you to get paid a $20,000 salary, and you would have to pay the self-employment taxes of, actually this one should just not even be here, of about $3,000. And times 3, that's about 10,000, all three of you. But we'll just look at each individual. So you have to pay $3,000 self-employment tax that you have to pay. We didn't issue you a W-2 yet, and so we need some money in the business bank account because the business is going to be responsible for paying the self-employment tax to the IRS since they're the ones issuing the W-2. That's why I suggest you keep money in the account so money can come out of there. If you take all the money out and we have to issue you a W-2 because we want to be compliant, then somebody's going to have to put the money back into the business so the business can pay out this payroll tax. That's why I suggest having the money in there. And since you took the money out, we already know that that's profit. And so that's why we'll have a reasonable salary. Unless all the money you took out, you put back into the business and you spend it all, and the net income of the business for some reason ends up being zero, that you essentially reinvested all the money and you didn't make any money in the business. In that scenario, we wouldn't issue you a paycheck, any of you, because the company didn't make any money. And so therefore you wouldn't have to pay any payroll taxes. And if you didn't make any money, then you also wouldn't owe any income taxes. But here is a scenario. Let's just make this $15,000 for fun. And let's just say you didn't have any additional income. That's all you had. So, you know what? Take that back. Yeah, no, that works. So we have $15,000 salary. Let's just say we issue you a salary for $15,000. You would still have to pay this self-employment tax of 15.3%, but you wouldn't have to pay any income taxes. So in this scenario, you would have to pay self-employment taxes, but no income taxes. But the scenario that we painted before is just $20,000 and $30,000, but just kind of shows you the difference of the taxes that you would have to pay. Hopefully this creates a little clarity on the concept of the play between the income taxes and the self-employment taxes, and why we want to keep some money in the account in case we need to issue you a W-2 to be compliant. And of course, we can hop on a Zoom call and we can mess with the real numbers of what you project your business to do. Like for example, if you do 3 more of these deals and you triple your income, so 150 grand, let's say 150 grand, let's just say we assume $50,000 would be a good salary, and you have $100,000. Just to contrast the two. In this scenario, you would pay about 1/3 of the self-employment taxes if you were a LLC reporting on your own personal taxes. And this is where the bulk of your tax savings would be. But do you see the difference? And then your income taxes, you'd be in all 4 of these income brackets, 10%, 12%, 22%, 24%. But the blended rate or the average rate is a little under 18%. So even though some of your money is getting taxed at 24%, not all of it is taxed at 24%, even though you're in that bracket. So hopefully this helps. I'm sure if we use some real numbers, it'd be a lot easier. And when you said if there's no money in the account, we have to issue you W-2, then yeah, somebody's gonna have to pay for it. So I think in this scenario, let's just say, I think Tristan and Claudia, they would understand when you make $100,000. Oops, that's $1 million. You may not have any money in your account, and you at the end of the year when you file your taxes, you'd have to come up with $22,000 in this scenario if you're single. And also to drive the point across also is if you make, we'll just make these $100,000. If you make $100,000 and you don't take any money out of the business, you're still going to have to pay these taxes, because it's the S corporation is what's called a pass-through entity. The IRS is like, the S corp doesn't pay any taxes. Whoever owns the S corporation has to pay taxes, and so all this income is going to flow to your own personal tax return. So you still have to come up with this $19,000, assuming you make $100,000, $50,000 income or salary, and then $50,000 business income. But anyways, let me know if you have any questions.